Hello. Finance can be messy, but don't worry. We clean it up with fun, facts, and maybe a little sarcasm. Welcome to the Financial Sandbox. Let's get into it. Don't forget to like, subscribe, and stay tuned for regular, raw, real financial talk in the sandbox. My guest today is Greyson Geiler. How you doing today, Greyson?
Good, Herb. Thanks for having me.
Absolutely. I'm really excited to have you on. I work in a completely different space in financial services. So I kind of want to start with the why. You started trading floors in Chicago.
hmm
Before we talk about gold, what did the trading floor teach you about fear, trust, and human behavior?
Well, it was a wonderful education, a real world education for the financial complex. I don't know if you remember Trading Places with Eddie Murphy, but they were going into the trading floor in New York, and they were talking about, well, this is the last bastion of true capitalism, and that was in the early '80s, right?
Uh,
Because it really is. I mean, in the financial world, in the commodity space, future space, there's a lot of volatility, and it's a zero sum game. It's not like the stock market. The stock market's better than a zero sum game.
uh-huh.
In the futures contracts, it's a zero sum game. Somebody's winning, somebody's losing. So hope, fear, and greed drives human endeavors all across the board, and it really manifests with the leverage and the winning and losing in the commodities exchanges. So it was a wonderful education in how the financial world works.
Most people think of gold as something you hide, you store, or you inherit. Uh, when did your view shift from gold as insurance to gold as productive capital?
That's a good question. So, I mean, I had it in my mind as insurance. When I was at the commodity exchanges, I watched Alan Greenspan in the late '90s bail out long-term capital management that I thought, as a 20-something, I thought that was ridiculous. We're the performance of the Federal Reserve hasn't gotten any better since then. So I filled my closet full of gold. And actually, that's a good question. So really, in the 2015, 16, 17 time frame, I couldn't understand how the monetary system was holding together. And I
Uh-huh.
found myself, Herb, a little bit angry that the system hadn't come apart and gold wasn't $20,000 an ounce. And then I caught myself. I said, how insane is that? That what, you want the system to come apart? No. So I really rewound and did a lot of homework, just on, all the historical stuff, the Hayek's and Milton Friedman's and all that kind of stuff. And in my homework, because I'm kind of a nerd and I don't watch television, in my homework, I found a guy who started, and for just to keep it simple, a gold bank. So people deposit gold, and businesses that need capital borrow and lease the gold. And I found him online, and I
Mhm.
thought, why didn't I think of that? And then I said, hey, I got to find this guy, and because I found him on YouTube, look him up. He's literally right down the street from me.
Wow.
Absolutely crazy that it worked out like that.
So you just mentioned 2015, 16, 7. We're in a crazy time right now with another uh, event in the Middle East, and recently we hear that the government's going to bail out Spirit Airlines. Watching all of that, and in your role in the commodities, and what you just said to me, what do you think about us bailing out Spirit Airlines? Should we just let it? Shouldn't we just let the market do what the market does? And if Spirit fails, it fails.
Yeah, well, I'm a libertarian at heart. I just recognize that practicality, it doesn't work like that.
Right.
And part of the thing is, when you look at the structure of our monetary system, understand that every dollar is borrowed into existence.
Yeah.
So think about it from a different perspective. If everybody paid off all of their debt, there would be no money.
Right.
So in a system structured like that, the currency units have to devalue as time goes on.
Right.
If they don't devalue, the system implodes.
Right.
And so it's just human nature that when they have to keep creating more currency units, the value of the currency has to continue down. The bailouts are going to happen. I mean, do you want to let the system implode? Do you want to have a true, deflationary meltdown? Or are you going to sacrifice the value of the currency and keep printing more and bailing out things like Spirit Airlines? Well, look at history. It's just human nature. They're going to keep bailing it out. It's politically expedient to keep bailing out. It's going to continue to happen.
Yeah, my personal thought is, hey, we should let the United, American, Southwest, whatever airline there is, say, hey, we're just going to acquire it and we're going to buy it at 60 cents on the dollar or 30 cents on the dollar and move on. Why are we the public fixing that problem? But anyhow, let me get back to my
we're
question.
On the same page. There's no way around it. It's going to get
So tell me, when I look at your fund, what problem are you really trying to solve for investors? Inflation, distrust in the dollar, portfolio volatility, income, or is it something deeper?
Yeah, well, that long-winded response coming, just so you know. And really understand that, just to set the backdrop, structuring this fund, we're getting a gold income, silver income on our metal.
Mm-hmm.
I'm the only gold fund manager that isn't dependent on the value of gold going higher versus the US dollar. When you think about it that way. So gold is money, always has been, always will be. You see the Dave Ramseys of the world, you see guys comparing, well, why would you buy gold? Warren Buffett always said, don't buy gold. It doesn't do anything. Why would you buy gold? Look at the S&P 500. And I say that's a ridiculous apples to oranges. Gold is money. It's not an investment. So if you really want an apples to apples comparison, well, if you have to hold a pile of money in your basement for 20 years, would you prefer a pile of gold or would you prefer a pile of US dollars? That is a true comparison. Now we, and also, Herb, remember, central banks, bullion banks, they've leased and lent their gold out for decades for a return on the capital. Because when you look at gold and silver aggregately, you're talking about $40 trillion worth of money.
Right.
Most of it's sitting around doing nothing. Well, that's why. Central banks and bullion banks have known that for a number of years, and they've lent and leased their money out, but it's been opaque. When you look into trying to understand what they were doing, leases were becoming loans, risk coming in. It wasn't structured properly. Well, like I say, the guys I found online, it's a true marketplace of leases and bonds that are denominated in gold and silver, structured, transactionally transparent, insurance, a true marketplace. Well, then we can sit back and say, okay, the whole world is reawakened to gold as the storage of purchasing power. And it doesn't have to be an all or none decision for you. If you have gold, well, some of it, I want to earn some interest on the gold. Assuming the risks are mitigated, why wouldn't you?
Right.
So that's more of a true comparison rather than gold versus the S&P 500. It's not a comparison. What are we doing? We're the storage of purchasing power with an income component added to it.
Hmm.
killing two birds with one stone.
So it kind of takes me to, people say gold doesn't produce cash flow,
Mhm.
right? What do they misunderstand?
Well, that's a really good question, and I think it's pretty intuitive in this day and age for people that have reawakened to gold to say, hey, purchasing power sitting in my basement. Hey, I'd like to get a return on that.
Right.
That's pretty intuitive. What's not so intuitive? Okay, well, who's going to give me that return? Who's going to pay for it? So here's a good example. So hypothetically, so nobody has to assume that I'm assuming anything. Hypothetically, Costco. Everybody knows Costco. They sold about 1 million ounces of gold last year.
Hmm.
Well, imagine being the purchasing manager of Costco coming into 2026, and you have to buy 1 million ounces of gold to be distributed between all the Costco stores to be sold.
Right.
It's a $5 billion capital outlay. I don't know the inner workings of Costco. I would guess they've got a better idea for what to do with that capital than purchase gold with it. So number one problem for a bullion company that Costco fills that spot. Number one problem is the capital. That's a lot of money to have
Yeah.
an inventory, right?
Yeah.
Number two problem is now they have price risk. So Costco buys a lot of inventory. Let's say they spend $1 billion on blue jeans to be distributed around to all their stores. Well, Herb, there's no secondary market of blue jeans. So no customers coming in and saying, oh man, the blue jean market got wailed on last week. So there's no way I'm paying that price, Costco. You got to lower that price and then I'll buy this. So Costco loses $500 million on their blue jean inventory. No, that doesn't exist. But that's exactly what exists in gold.
Right.
Right. So if Costco is trying to, as part of their inventory, hey, buy gold from us, and Costco's probably marking it up 5%, whatever the number is.
Sure. Yeah. Yeah.
Well, now there's a secondary market that tells everybody walking in, wait, I don't care that Costco paid $5,000 for it. If it's only 4,700, I can go to the coin shop down the street and get the same thing. So now Costco has all this price risk. January, February, bad months for gold, lost 10%, whatever the exact math is. Well, Costco just lost $500 million. So they've got the capital outlay. Now they've got price risk, and they're just trying to make 5% on every ounce. Well, why would they do that? If they could get a lease from us, so it's really actually our gold, we still have title to the gold. Again, I'm speaking hypothetically. We still own the gold. It's just sitting in Costco stores. We've got an inventory management program to mitigate the risk, all that kind of stuff. Well, it's a win-win because Costco, they don't have the capital outlay. It's not their money. They don't have the price risk, but they can sit there and turn it over 12 times a year. Somebody told me Costco's entire inventory turns 12 times a year.
Wow.
Okay, great. So you turn it over 12 times, you make 5% 12 times, you pay us 5% once because it's our gold, and there's just a little conveyor belt. They sell some gold, well, they buy more gold and put it back on the conveyor belt, and the gold that's on the conveyor belt is ours. So it's a win-win, and I use Costco just because everybody knows them. I'm sure their brass isn't going to come after me for that. I hope, because I say. But anyway, so that's a good example in the retail space. As a bullion dealer, jewelry is the exact same way, right? Their inventory is so expensive they can't afford to own it all, but they need big inventory because their margins aren't that huge. So what if it's our gold and silver that they're selling? It's better for them to get their capital this way than in US dollars. Costco they've got the capital. A jewelry conglomerate, they probably don't have the capital. Well, they've got to get it from somewhere. So if they borrow dollars and they buy all that gold for the jewelry, well, again, now they've got price risk, and gold doesn't have to sell off too far if they still owe dollars, but the value of what they own is selling off, now they're in big trouble.
Right.
Banks that give them the capital know that. The banks make them short sell gold futures contracts. Now you've got a whole different animal with the way the futures contracts have been running around the last few months. Jewelry retailers, wholesalers, people trying to lay off price risk into the futures contracts actually took more, and they got killed on both sides. They're coming for, they want leases. They want to get their capital in the same currency that their liabilities or their future income is going to be in. Yeah. So that's on the lease side, where it's very low risk for us. People have, companies need capital and they want to use our gold. And then there's the producer side of gold and silver, the gold miners. Well, if they're using our capital, they have to take the gold and silver from us. They owe gold and silver from us, but when they get it from us, they're liquidating.
Right.
They're liquidating for US dollars or whatever currency they're in. They're buying trucks, they're paying payroll, the gold is gone.
Right.
But now what they owe and what they're going to produce are matched up. So they don't have any price risk. It's a better hedge than how they've been doing it historically. And sorry, I don't know what happened with that lighting. But the gold, the leases and the bonds are two different animals. One of them has more risk that has to be mitigated, therefore a higher return rate.
Right.
And the leases is just somebody using our capital. Just like if you go to a car dealership doesn't own all those cars. Car manufacturer does. The dealership's leasing them.
They're leasing them, yeah.
Because they don't have the capital to own all this. So it's the same animal, and I hope I didn't get too far off on a tangent there for you.
You did, but that's okay. My audience will get back to me and they'll make comments. Okay. When people hear yield on gold, some will think, well, that sounds kind of too good to be true. I mean, what's the most honest way to explain where the yield actually comes from?
Well, that's what my Costco rant is supposed to do. But just the basics of it is understand there is a natural interest rate to gold. If you have a pile of gold, there are people in the gold business that use gold that will pay you a gold interest rate to use your gold. I mean, it's that simple.
Right. Is the investor earning a true yield, or are they compensated for the credit risk, liquidity risk, counterparty risk, or just the complexity?
Yeah, that's a really good question. And on the lease side, like I say, the risk is almost completely mitigated because you're maintaining ownership, you're maintaining title of the metal. There's insurance on most of these contracts as well. So when you're making 3%, 4%, 5%, whatever the exact interest rate is, it does match up. Then on the loaning, actual lending metal to the mines, to the gold and silver producers, there's more risk that needs to be mitigated. Pretty much the same as if you log on to your Schwab account and you buy a Coca-Cola bond, any corporate bond.
Right.
There's risk to.
Yeah.
Most people don't think about it like that. They'll buy a bond mutual fund and just hope there's not a 2008 and hope there aren't a bunch of defaults.
Right.
But it's the same animal. It's just the currency of these transactions is gold and silver. It packages in a free hedge for the mining companies. So typically, but again, there's more risk to be mitigated. So typically you're talking about more like 8, 10, 12%, something like that.
Right. In your world, what's the difference between owning gold, leasing gold, lending gold, and owning a fund that does these things? Yeah.
So, and that's an evolution for a lot of people because we're in the early innings of a yield on gold.
Ah, okay.
Right? Like I say, the bullion banks have done it for years and years, but as far as a marketplace where individual investors can participate, the marketplace we're using is 10 years old. So it's not brand new, but we're still in the early stages. So for a lot of people, it's kind of surprising. Wait a second, I've never heard of a yield on gold. Let me just put a toe in the water. Put 10 ounces of gold in. They're logging into their account. They see more gold deposited in their account every month. They're like, oh, okay, this is cool. So when you look at, the last 6-8 years, and this is anecdotal, this isn't a statistical analysis, but so many people have started accounts with a small amount of gold and silver, and the typical account is 3 or 4 times the size that it started years ago.
Right.
So it's an evolution of people's thinking when they start to realize, hey, gold isn't, I have to hold it tight to my chest. And if you want to hold some, that's great. It's not an all or none decision. But for some of your capital to get a return, okay, how am I getting the return? How much risk? And all these things are the details of the trade.
So what has to be true for this cycle to work over a full market cycle, not just during a gold bull market?
Mm-hmm. Yeah, so, well, that's a good question too, because, when gold was up 65% or whatever in 2025, and some people will look at me and say, okay, your fund is on pace for 8% over gold this year. Well, when we're talking about 65%, what's another 6 or 8%? What is it? So people kind of, the different part of the cycle that's the part of your question I'm trying to address, because right now some people aren't that excited about it.
Yeah,
but,
yeah.
If you look at it historically, in 2011, we put a high in gold that we didn't get past for pretty much a decade.
Yeah, yeah.
Well, if a decade goes by and you didn't make any money with the Federal Reserve conjuring trillions more currency notes, you feel pretty stupid.
Yeah.
Right. But if you're making 6 or 8% and you're just acquiring more ounces the entire time, well, a couple decades go by, you can worry about what the dollar value of those ounces is. The key for this from the investor perspective is to think about it in terms of ounces. I have this many ounces. This part of my portfolio is in ounces rather than dollars, and I'm going to invest these ounces to continually get more ounces. And surviving the cycle, as you say, for the borrower or leasee side of it, there's less influence on the price of gold and the spot in the cycle. Plenty of businesses that use gold need capital. They'd prefer to have it in gold terms for an easy hedge, no matter where we are in the cycle, so they can do their planning. And they can just make their margins for the value added that they provide.
It's very interesting. A colleague of mine asked me a question to ask you, and I was going to go a different direction, but I think it's really appropriate at this time, right here. What are your thoughts on gold acting more like a stock than a hedge fund these days?
Yeah, the volatility of it, I'm not a big fan of. I'm just, like I said, I mean, my fund has the capacity and the expertise. It's how I grew up. It's hedging. I've got the capacity to hedge some of the downside moves in US dollars. I'm not really concerned about that. In an environment where gold's going up and I'm earning interest.
Yeah.
But there's a lot of speculative interest that comes in with leveraged vehicles that's lending for this volatility, for it to act more like a stock really than a true world currency, which is what it is.
Mm-hmm.
So yeah, the added volatility doesn't help, but I would submit that because of this volatility, unless you consider yourself a great market timer, why wouldn't you want a gold income on your gold? And
Sure.
especially silver. I mean, take a look at silver. Runs from 32
Yeah.
to 113 last year.
Yeah.
Now it's 75, and everybody's thinking, "Oh, why didn't I sell it over 100?" Well, because you thought it was going to 200 when it was over 100. That's why you didn't sell it.
Right.
So now they're frustrated. Oh, well, if you had sold it, are you buying back now? I mean, if you want to have a spec account and try to time it, good for you. I hope you're smarter than I am. But for people that just want to hold the metal for the long term, consistently getting more ounces takes away some of that anxiety that I didn't sell the high. I didn't have to buy the bottom. I didn't have to get in and out. I don't have to pay taxes on the principal because I sold it and I want to buy back. Oh, I sold my gold, hasn't really sold off yet. So now it's higher than where I sold. Do I need to buy back in because I'm worried about the dollar situation? All this, getting
I'm
an
sorry.
income in
Are you
ounces.
talking about the real estate market? Are you talking about the real estate market or the gold market?
Right.
Right?
Yeah, exactly.
Those people who are saying, if I had sold in 2020, blah, 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 right?
Oh
so,
my gosh.
Sorry to interrupt you there. It just was.
It's okay, because I mean you're dead right. I mean you're pointing out just one of the human nature sides of investing that you're never going to get away from. You're always going to have that feeling. I'm just suggesting that for part of your precious metals portfolio, consistently getting an income on it takes away the anxiety, and you can leave the principal alone. Then you want to. You want to sell the interest you've earned and go on vacation, knock yourself out.
Right. Why is gold no longer inversely related to the stock market?
Well, and I'm not sure that it's always going to be that way, Herb. I mean, when you go back decades, they're really uncorrelated.
Yeah.
I mean, they'll have runs together, they'll have sell-offs together, and sometimes they'll be doing the exact opposite. So if you stretch out your timeline, you'll see they're really uncorrelated, which really helps with just the strategy of diversification. Isn't so much I got this much in stock and this much in bonds. You know, maybe add some gold in there because it's not as interest rate dependent as the bonds and real estate running together are. It's not. Over time, I think it'll be more uncorrelated rather than the correlation it's had over the last couple of years.
Well, and on that same vein, you've said that the world is still dollar dominated. Why is gold becoming more important, not less?
Well, so this really started changing in 2015 when we had zero interest rates and we just started conjuring more money, telling especially the Chinese, hey, we don't respect all your financing of us, buying all of our treasuries. We don't really respect you doing that for us, so we're just going to conjure more currency. So when you look at on the net, of course, there are central banks that have bought U.S. treasuries since 2015, but that's really on the net. Since then, central banks have not been buying treasuries. Right. And it's a function of miscalculation on the central bank part, just conjuring all the currency. I mean, you look at the M2 numbers, it's gotten pretty ridiculous. So when you're the Chinese, they've got a problem with the power that the world reserve currency status gives us.
Yep.
Well, they're not willing to forego their capital controls on the yuan and make the yuan the world's reserve currency. So they've really, and part of their problem is they've got a debt bubble that's worse than ours. They need their yuan to devalue, to continue to devalue. Sure. Yeah. So they've kind of split off the holding the purchasing power function of money and said, hey, for a unit of account and a medium of exchange, we'll still use yuan, we'll still use US dollars around the globe, but for the storage of value function, the Chinese are really imposing on the world. This is how it's going to be. The Indians are involved in that. Of course, we told the Russians you can't use the US dollar, so they had to find an alternative. None of these guys trust each other to build a currency. The only time they trust each other is when they're all hating on America. They're not gonna produce their own collective paper currency. It's not going to happen. They've already got the currency. It's gold.
Right.
The Chinese are building depositories all around the globe to make it more a part of the actual monetary system rather than just clutch your gold. And what we're working on, the obvious next step is that interest rate on gold.
Right.
And we're on the cutting edge of it. So I hope I answered your question.
You did. But it led me to two questions that I had. Are central banks buying gold because they fear inflation or sanctions, or is it just political weaponization of money?
It's all of the above.
Yeah, I was going to say, I was like, all of the above.
Yeah, it is. It's all of the above. So they've already bought first quarter of 2026. They're on pace for another 1,000 tons for 2026. I don't think they quite got there in 2025, but gold is back to the number one asset on central banks' balance sheets. But I don't want to go off on another huge tangent, so I'll just
make it tiny.
I'll just throw it out there, and if you want me to go there, I'll keep going there. But the one thing that is completely counterintuitive, because this de-dollarization is all over the financial media.
Yep.
But there's also a dollarization going on through the crypto world. And that's it's just a breeze at the back of the Federal Reserve right now, but it could turn into gale force winds.
So what changed after Russia was pushed out of parts of the dollar-based financial system? Did that permanently change how countries think about reserves?
Absolutely it did. There are a few indicators, like I'm talking about 2015, but a real turbocharging of this attitude is when we froze, some say 200 billion, some say more. Let's just say $200 billion of Russian assets that were deposited in banking institutions that we had influence over. We froze it. And we told them, hey, the whole SWIFT code, you guys can't play anymore. How insane is this? Right. Russia, perfectly willing to drill their oil, pump their natural gas, grow their wheat, mine their platinum, hand it out to the rest of the world, in response for US dollars, perfectly willing to do that. We told them, nope, you can't do it anymore. Mm-hmm. So that absolutely turbocharged the idea of central bankers around the globe. The Indians, the Chinese were already there, but it turbocharged it. Hey, the Americans are weaponizing the world's reserve currency status of the dollar. They're weaponizing it. We have to think of a plan B.
What do you think about how to address the physical reserve limitations and increasing gold ETF environment?
Ask that again. Let me make sure I understand the question.
Kind of what can you address the physical reserve limitations on gold? And it's sort of there's an increasing gold ETF environment where there's new energy in the ETF space.
Yeah. And a lot of these guys, a lot of people are concerned about GLD as far as how much gold does it actually hold. Some of these other ETFs, do they actually hold all of the gold that they claim they hold? And everybody's got to do their own due diligence on that. I have my opinions on that. In a normal marketplace, these ETFs are going to track the price of gold, and I'm not worried about it.
Right.
But when you see futures markets, when you see the market really unhooking from reality, and the thing to look at the way we've got these futures contracts set up in gold and silver
Yeah.
is when you see a real backwardation. There's a normal contango. Next December contract of silver is priced higher than the May contract of silver because there's a cost of carry. So of course, 75 today, maybe it's 82 in December. That's a normal contango for these futures markets. So if these type of things concern you, the indicator you should have on is when the front months are wildly higher priced than the back months. That's a backwardation. And that's when the cash market and the futures markets really unhook. Silver is such an archaic marketplace that happened. If my alarm, if people were paying attention to the alarm I just described, well, they would have been freaking out in January in the silver market because it was so wildly backward. But the cash market flow of silver is so wildly archaic, that's not a huge surprise. If that starts happening in gold, it's a different animal, and it is a concern. And you have to think about, do I really own this gold?
I got to tell you that this is the nerd conversation when it comes to gold.
Yeah.
So
yeah, it is.
Let's talk markets here, right? And portfolio. Where does this fit in a serious portfolio?
Yeah.
A lot of allocation research uses gold as 2%, 5%, or even 10% of a diversified portfolio. I mean, State Street has modeled hypothetical portfolios at 2%, 5%, and 10% allocations.
Yep.
Where do you think the smart range is for the real investor?
Yeah. So, and some guys like a Ray Dalio has it at 20%.
Wow.
And I think obviously everybody's situation is different. And for a Ray Dalio with tens of billions, a higher percentage in the all-time wealth indicator gold makes sense.
Yeah.
I think for average people like you and me, and there are a lot of white papers that have been done with 5% that shows, I mean, just over decades, you've got a lower volatility and a higher rate of return around that 5%. And I think when we can add a consistent income in gold and silver, I think you're pushing towards 10%, I think is reasonable.
So
does that make sense? The income is going to increase the viability of this part of the portfolio.
Right. So if an investor already owns real estate, bonds, stocks, they've got cash and maybe some alternatives, what should a gold allocation replace or add?
Yeah. So I think what's happened to a lot of people, and I think it's reasonable, is a lot of people have gotten more concerned about fixed assets denominated in US dollars. So broad and general, this is not financial advice. I don't know your specific financial situation, but broad and general, what I'm trying to describe to a normal portfolio owner is, well, if you are in that 60-40 world, 40% in bonds, why don't we take 10% of that 40% and make it a gold with gold income, silver with silver income?
Right.
Take it from that fixed part of the US dollar portfolio, because look, again, US dollar is not going to zero anytime soon.
No.
But the Fed's going to keep printing, and they have to.
Right. For the retiree who needs income, how do you explain the difference between the dollar income and ounce denominated income?
Yeah. So and part of this goes back to your volatility question, because understand that when you're getting an income in gold, well, let's say you get 2 ounces a year. I'm just pulling numbers out of the sky. If you get 2 ounces a year in gold income, wow, does that look different in 2026 than it looked in 2024?
Right.
So you've got your inflation hedge right there. But I think for retirees that have to have income off their portfolio, we should get a base living built off your US dollar portfolio, US dollar income. Get that base living that you're comfortable with locked in. And we can call our gold income, because it's already hedged to inflation. We can call our gold income, some icing on top of that cake.
And to my audience, I really want to say that we're not giving you advice as to how to change your portfolio. These are suggestions. These are thoughts. They're definitely something you should talk to your advisor about at length. What kind of investor is wrong for this? I mean, who should not be doing this?
Yeah, so that's a good question too. So people that are really living tight and need a guarantee of income coming in just to pay their bills, pay the electricity, put food on the table. I'm not a doomsdayer on inflation is going to crush you. I'm not. So I would be comfortable telling everybody, hey, get a base lockdown for your lifestyle in US dollar guaranteed. And if you don't have the resources past that, I don't think the strategy I'm discussing is for you.
Right, right. You've said that gold is more monetary and silver has a larger industrial component. I mean, that's how I'm interpreting it. How should investors think about silver without making it a speculation game?
Yeah, funny that, and I'll send it to you. I just did a video yesterday because of this wild volatility in silver. We have to look at it more as a capital asset, or it's strictly speculation.
Yeah.
But if we can get an income off of our silver in silver terms, it mitigates some of that volatility. And the good news is there's some really big names coming in to use silver as a capital asset. We have a structured note out to StoneX that's a Fortune 100 company. And that's denominated in silver with a silver interest payment. Because I mean, the volatility, especially in silver, has gotten pretty absurd.
Is silver the emotional metal and gold the institutional metal? Would you say that?
Yeah, there are lots of analogies through the years. The crazy cousin silver, the more volatile younger brother, whatever you want to call it. Understand that a big part of it, Herb, is because the silver market is a 20th the size of gold.
Right. Yeah.
Even a little bit smaller than that. I mean, it just depends on when you're doing the statistics, if we're talking about dollar value. So the smaller markets lend for more volatility, and the speculators are attracted to more volatility, augmenting that more volatility. So that's pretty much a 1 and 2 right there. That's not a complex analysis, but from 20,000 feet, that's about it.
Right, right. So what do you think the biggest misconception Americans have about the dollar?
I think the big problem I'm looking at is it's just so easy in clickbait world to get polarized.
Yeah.
The US dollar is going to zero. Well, my opinion is no, it's not. And so people that may be inclined to do more homework get turned off because of the extreme volatility of that. And so they don't look into, some of the things that are legitimately moving in the US dollar world, both good and bad. Like I say, there's a de-dollarization from central banks and a dollarization through the stable coins. So I guess that's my biggest problem is it's so hard for people to think objectively about the US dollar. because for most people, and they got to take the kids to soccer, they got to get to work. I mean, that it's a good thing that they don't think like I do, or the world might stop spinning. But the downside to that is it's a lot of people are just fish in water. They don't realize that it is water. That's just what they know in the U.S. dollar. And when they see the extreme volatility of the financial media talking about it, they're turned off and they just keep living their lives when they could dig in and learn what's really going on.
In that same, going down that same street, what does Wall Street get wrong because it's too dismissive of gold?
Yeah, and that's been pretty easy up until the last year and a half, 2 years, because look, I mean, let's call a spade a spade. On the Treasury's balance sheet, gold is still $40 an ounce, $42 an ounce. Why? Somewhere in here they're going to revalue it, and it's going to be something they can lend against without having to issue more bonds. But when you look at the 70s to today, man, it's just a lot easier to kind of scoot it to the side, and maybe we shouldn't talk about the price of gold. Let's just kind of leave it alone. It's not tax advantaged. It's tax disadvantaged, really. Regulatorily, it's kind of disadvantaged. So it's been cleverly scooted to the side, which lends for not really much happening.
Yeah.
And that's what's happened.
I mean, it takes me to like when gold is screaming higher, how do you keep investors from confusing price momentum with wisdom?
Yeah. And that's as hard as any market that moves that far, that fast, right?
Yeah.
And again, I'm talking my own trade, obviously, but I don't mean to beat the same drum. But when you're getting an income off something, you worry a lot less about the dollar volatility. You just don't care as much if there's an income coming off of it. And we can even talk about that with stocks.
Yeah.
The high dividend paying stocks, somebody's in Procter and Gamble, are they really looking at the capital, the principal appreciation of their Procter and Gamble, or they've just been looking at that as a tax advantaged income stock for decades? So it's along those same lines, and there's a wake up coming. I mean, largely we're already here, but like I say, for the income on gold and silver, we're in the early innings. So there's a lot of opportunity going forward, and I think as time goes on, that will lend for less volatility in the actual dollar movement of these commodities.
What do you know now about risk that you didn't understand when you were younger on the trading floor?
Ooh. And that's funny, but it's really been amplified in recent years. Of course, in the commodity space where you're using a lot of leverage, getting rid of losers is the most important thing. Absolutely. Getting rid of losers is the most important thing. And then you get out of the levered world and you don't worry about, it'll come back. Whatever investment you're in, it'll come back. And you're not levered up, so it's not crushing you. And those same principles, whether it's levered or not, those same principles keep coming back. The good ideas, stick with them. The bad ideas, get rid of them.
Yeah, talking about you on the trading floor when you were younger, as we stay there, what's different for you today, and what would you tell the younger Greyson when he first on the trading floor from today?
I guess to the younger Greyson, I would reiterate what I tell everybody that I sit down with when I sit down from a registered investment advisory capacity. I tell people the number one mistake I see in financial planning is no planning. No planning. That's the by a wild margin. That's the number
Sure.
one thing that I see. And the number two mistake I see is not a big enough emergency fund. Wild stuff happens, prepare for it. Don't invest everything you have a stack of cash in your basement if that's what you want, cash it in your checking at Chase, if whatever your comfortability is, a bigger emergency fund. And I always told myself that through the years, but you're asking me what I would tell a younger Greyson. I would smash that in his face.
If gold, silver, Bitcoin, and the US dollar walked into a bar, who would start the fight?
Gold, silver, or Bitcoin. That's a good one. I
And the US.
in this day and age, I would probably say silver. Because silver feels like feels forgotten about.
Right.
Oh, gold's been making new highs for the last couple of decades. What? You guys forgot about me just because I traded 50? I traded 50 in 1980. Come on.
Silver in the first
Silver would start the fight for sure.
What movie better explains gold investors? The Big Short, It's a Wonderful Life, Goldfinger, or There Will Be Blood?
And I don't know There Will Be Blood. I don't know that one.
Yeah, I didn't really know There Would Be Blood either. It's been a while, right?
I think that one's pretty easy. It's a Wonderful Life.
Yeah. Why?
By far, because gold is just it's not conjured up by a central banker. The interest rate that we're getting on our gold isn't dictated by Jay Powell. It's just real, it's consistent, and you might have years that go by that it doesn't feel that great. But it's just a good stable foundation to a portfolio for people, I guess I would say. Where I'm looking at stuff like The Big Short and
right.
Man, that's generated by leverage and central bank malfeasance.
So you've talked history. I love that you have a good grasp of it. If you could sit down with Richard Nixon in 1971 after closing the gold window, what would you ask him?
What I would ask him, was it really necessary to pretend like it was temporary? That I don't think most people, I don't know. I was born in 1971. I don't know that most people really believed that it was temporary. But for the people that believed that it was temporary, that's really misleading, because Nixon he knew it wasn't temporary.
Right. Yeah.
So I guess that would be my question for him. Was it really necessary to lie?
So I have a couple of fun questions. I've started already, but I like to throw them in there, right? If gold had a dating profile, would you say it is stable, low drama, emotionally unavailable, but great in a crisis? Where does it fit?
Wow, interesting question. It's not as emotionally unstable as I would have hoped from watching it over the last few years. The last 6 months, it's gotten pretty wild. So it should say there may be some volatility. There may be a little more emotional volatility than you expected, but I'll always be there for you. That's what a dating profile should say.
If gold were a cartoon character, is it Scrooge McDuck swimming in a vault, suspicious of everybody, and somehow still the richest guy in the room?
I don't think so. I mean, and especially with what we're doing with gold, I wouldn't be spending my all day every day if I didn't think that this was a new evolution in gold that was going to take it to a different place. Because 20 years ago, you could have easily called it Scrooge McDuck.
Sure, right? Yeah.
But now, I mean, we're filling an economic need. Herb, there are lots of businesses that cannot handle this volatility in US dollar prices of gold and silver. They can't handle it. They don't want it. They need capital to run their business. Hey, if you give me capital in ounces, my life's a lot easier. So we are filling an economic need that's a different that gives it a different flavor than Scrooge McDuck distrusting everybody. It's back as a capital asset.
So are you saying that gold is SpongeBob, always absorbs some panic, lives under pressure, and somehow has fans across every generation?
Well, I would definitely say that gold isn't Patrick, the idiot of the skit. I would definitely say that. The analogy with SpongeBob I would not have come up with, so props to you on that. But yeah, SpongeBob's always there, and he doesn't completely come unraveled, even though, well, sometimes he does.
SpongeBob is one of my favorites. My nephew Jamil and I watched SpongeBob all the time. We still talk about SpongeBob, and you seem to have a great knowledge of SpongeBob.
Well, I'm a late bloomer, Herb. My girls are 13 and 10, so SpongeBob was on my TV up until a couple years ago, quite a bit.
So looking at SpongeBob and living under the sea, which character is you in SpongeBob?
I don't really understand the question. Which character of SpongeBob?
Yeah. If you had to,
which character of SpongeBob is in me?
Yeah. In the show, which one is you?
Boy, that's
probably not Patrick. I don't think.
Yeah, or Squidward. I don't know the show that well. I would guess I'm probably SpongeBob. I can be an idiot, but intentions don't go dark. So maybe I'd be SpongeBob.
Awesome. Well, folks, that's a wrap. Don't forget to like, subscribe, and stay tuned for more real, raw financial talk in the sandbox. Greyson, thanks so much for joining me today. It's been awesome. And
anytime, Herb. I really enjoyed it.
Yeah, me too. So we'll talk soon.
Okay. Thanks, Herb.
All right.